Hi, David Moore with Equity Advantage, and I'm here with Robert Smith at Peregrine Private Capital, and we're talking all things, institutional real estate today, and inflation and different things. And the government made a couple changes a couple years ago with the credit investor rules, and one of them really, honestly, is sort of ludicrous, and I think it's sort of the government's position on people owning their own homes when they took the home out of their accreditation criteria for accredited investors. And I would argue that somebody's home is probably the best investment they've ever made. And I really sort of believe in today's world that the government doesn't want you owning it. I think they want people to just be living in apartments owned by REITs. But that's another conversation. But along those lines, I think it brings up an opportunity. It's something that people don't think about much. Because if we look at the sale of a home, and we look at Section 121, the Universal Exclusion, and by the way, that rule was put in 1997, and the exclusion gives an individual $250,000 exclusion on gain, $500,000 for a married couple, and for you to qualify for that exclusion, you just have to have lived in the home for 2 out of the preceding 5 years. So it's not what the property is at time of disposition, it's just whether you fit that 2 out of 5. So you could be in your home, and as long as you sell it within 3 years of moving out, you're still entitled to the exclusion. Now, the reason I bring that up is 1031 applies to what something is at time of disposition, right? So what I'm saying is you could have a home, you could have lived there for years, and if your gains are in excess of 250 or 500, which, I mean, before the inflation, I'm sure you had gains beyond those things, a lot of people out there, but today with inflation, think of what that's doing to people's ability to just shelter the gains from their home. And everybody's so happy that their values are just going through the roof, but it's triggering big tax problems. So what I'm here to say is you're not stuck with that tax obligation. So think about this. You could have a situation, you've lived in your home, your gains might be, and I would say that 121 instead of 250 or 500, maybe it should be $1 million, $1.5 million today. And that might be low. But if we look, because in 1997, I mean, you could buy, in Oregon, you could still buy a house for 60, 70, 80, 100 grand, right? It's not going to happen today. So it's 5 times that today, probably. So we had to go 5 times the 250 or 500, probably. So my numbers are low. But the bottom line is you don't have to pay the tax, all right? Move out of the house, season it as investment property. And then after you've held it as an investment for a period of time, that doesn't mean that it's rented out. You could then take the exclusion. You're still entitled to the 250 or 500 if you fit the 2 out of 5, and you 1031 the overage. And I'm going to swing back to you with that overage. What can they do with the overage? What's a good end game? What options does Mr. Smith have for somebody that doesn't want to pay the tax on the sale of their primary residence?
I think that's
anything else.
I think that's you make an excellent point, David, that the current shelter for primary home valuation is archaic at best. And as we mentioned, we don't see inflation abating in any way, shape, or form. It's likely to accelerate and become worse. That being said, it's probably not going to take much, these interest rate hikes on the part of the Fed isn't going to take much wind out of the sails of the housing market, because there's still a screaming shortage for single-family homes and, for that matter, rental housing. So it will probably accelerate price escalations on the part of single-family homes. So addressing your point, that issue is going to become even more pronounced, and you're the first one in the space who that I'm aware of that's made the suggestion that there's an opportunity to avoid that by moving out of it and then doing a 1031 exchange. And given the price or value of houses these days, I think that's a very good idea. That being said, one of the end games that we see increasingly is consideration of the 721 UPREIT. When we started in the business 20 years ago, it was 721 UPREITs were really very much of a niche business. But fast forward 20 years, everyone's 20 years older, so we're seeing more conversation, more demand for the product. And all that is I mean, it's a two-step process. First, you do a 1031 exchange into an individual DST property or properties that are attached to the 721 UPREIT. And then at a predetermined interval, usually 12 to 24 months, then that DST property or the interest in that DST property are going to be absorbed into the 721 UPREIT in another tax-free exchange. And then it will be your fractional interest will be changed into operating units of the trust, and you'll benefit from greater diversification. And usually those REITs can also lever themselves more aggressively. So oftentimes you see a substantive increase in cash flow from your initial DST offering, and then you can change on an ad-needed basis those operating units into shares and sell those shares off incrementally at a time that works best for you in terms of generating liquidity and managing your capital gains tax event, while the balance remain in the operating units, which then, if you still have at the time of your passing, your heirs will receive with a stepped-up cost basis. So for people, getting towards the end of their life and they're not interested in multiple exchanges or continuing to change forward, it's a very viable option.
Not that there's anything wrong with those continued exchanges.
No.
I'm joking, right?
Right.
But I sort of look. I interrupt you, but I look at 721, and once again, I want to stress: you cannot exchange into a REIT. The only way you're going to get into this REIT is through the UPREIT, the 721 process that Robert just explained. And I look at it honestly as the ultimate installment sale.
Right.
If you sell a property to somebody and carry a note and trust or contract, one, you're at risk of them defaulting. Two, unless you put some type of acceleration provision in it, you're at risk of having that note or contract paid off before you thought it was going to be. And that happens all the time, by the way. If somebody sells a property, they want to do an exchange carrying a note, we can do it 5 different ways. It's another conversation. But you need to, if you're going to sell and carry paper, the accommodator's got to be somebody that's prepared to deal with that and going to get you where you need to go. On the other hand, if you're just going to sell and carry the paper and you think, hey, I want 10 years of income at this rate, I'm not saying don't sell and pay the tax, but just control that situation. So you better have some type of acceleration provision in place, because that buyer might sell to somebody else that wants new finance, or that buyer might pay you off sooner than you wanted, or something else might happen, or they default. So you look at that 721 and that conversion from a situation where you're in control of having to manage the assets and everything, truly into an installment sale that matures at your choice is an amazing thing, and at the amount you want to. Because if you sell and carry a note, you get that note. I can't help you when the balloon payment's coming in. And that happens. I took probably 2-3 calls last week on that, Bob, where somebody had sold, carried paper. Now they're getting the balloon payment. Now they're wanting to do an exchange, and it's too late. So I love this process, and I think that you literally sell shares at your need, when you want, or when it's going to be the best for you tax-wise.
Right. You can stage. Not only can you manage your own liquidity event, but you can stage the capital gains tax ramifications from that, so that it works at a time that is most advantageous to you. And again, if you don't convert, there's no reason ever to convert all your operating units to shares, because as long as they're in the operating unit format, what isn't converted, again, can be passed along to your heirs on a stepped-up cost basis, so the balance of that capital gains tax liability passes with you. And so there are lots of advantages there from an endgame standpoint. What people need to understand about 721 UPREITs is they all have different compositions from a property type standpoint. And so if you're considering this as an exit strategy, you want to look, we think, you want to look for those REITs that aren't just a hodgepodge of, well, we've got some industrial properties here, we've got some office properties here, we've got some retail properties here, a little bit of this, a little bit of that. You want to look for a portfolio that is thoughtful and that is that addresses our current inflationary issues and or the ultimate likelihood of a recession that will come in the wake of that. Meaning, look for a property portfolio that's well thought out. What property types historically do well during recessionary environments, whether it's medical properties, multifamily properties, those things that people can't live without, and what kind of properties are structured from a rental income stream so that all of the things being equal in terms of occupancy, we can continue to push those rents and hopefully push the cash distribution from the REIT. So that needs to be a thoughtful process on investors' part in terms of, okay, I like the 721 up REIT option. Now I've got to really drill down and determine from a composition standpoint what 721 up REITs are good and which ones are not so good.
Or how much you want in them and how much you don't.
Yes.
But I think you made a comment that's very important to, once again, point out the stepped-up basis was under attack and Build Back Better, and it's survived to this point. But I think, and we're talking about that billionaire tax that was just proposed too. And what do they want to do? They want to go mark to market with those unrealized gains, right? So I want to stress that there are people in our business that will say, well, 1031 is a tax-free exchange. It's not tax-free, it's tax deferral. So when we're doing any of this stuff, the beauty of, I look at the UPREIT, the beauty is, gain is not realized until you realize it, right? Until you sell the stuff. So we've got tax deferral into this instrument. And the fact, normally if you sell on an installment sale, you're going to be paid off at the rate that that note or contract dictates. But with the UPREIT, if you've got losses over here, you can offset those losses with the gains on the other. So you literally sell shares as it suits your needs. So, I think that's an incredible opportunity for people that actually have the professionals in their life to help them plan those things. So once again, I always say one of the most important people in your life is your tax counsel. You want to have great tax counsel, and you want to talk to them before you sell stuff, right? Don't talk to them April 14th. Talk to them before a year's in. Look at what you got going on. But I just like, from an estate planning perspective, the 721 is a tremendous opportunity for people. And Bob's last comment, I just want to re-emphasize, it's this distribution, the allocations, you want to go with different things. 1031 is going to allow you to exchange into multiple assets, and maybe you're going to talk to Bob here and say, okay, hey Bob, I've got X dollars to do. This is sort of my objective, and he's got the time in the business to help you sort of balance it out between maybe DSTs and the UPREITs, and maybe they even want to go into something called NOZ, which we'll talk about in a few minutes. So I just want to point there are options that are out there, and there's things that are there that you don't know of, right? And so you got to talk with people that are aware of these things. They're going to give you the options going forward. Don't get pigeonholed into, hey, you got to only do this thing, because I always like to say in the tax world, it's rarely a question whether you can or can't do it. It's how you're going to get it done. And once again, somebody comes to me and says, hey, I want to exchange into a REIT. Well, you can't do that, but hey, we can get it done through this 721 UPREIT situation. So once again, David Moore with Robert Smith at Peregrine Private Capital, and we'll be right back. Thank you.
I can see straight right through you. Took out my phone